Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, let's get into it. Today we're looking at the U.S. market analysis for April 14th, 2026.
This video presents a direct informational narration of the source document. So, here's what we've got on the agenda. First up, we'll cover the risk disclosure and a quick market overview. Then we'll dive into an analysis of inflation and volatility. After that, we're going to look at some index and stock technicals, and we'll wrap things up with flows, strategy, and our conclusion.
Okay, let's kick things off with our first section, risk disclosure and the market overview.
We begin with the required notice. This document is provided solely for informational and research purposes and does not constitute investment advice, a recommendation, solicitation, or an offer to buy or sell any financial instrument. Investing in financial markets involves significant risk, including the potential loss of principal.
Prices of equities, indices, derivatives, digital assets, and other financial instruments may fluctuate materially and unpredictably. All strategies, market views, and analytical content are presented for reference only and do not constitute trading instructions, portfolio management guidance, or guarantees of future performance. Any investment decision should be made independently by the reader.
So what was the story in the market today? Well, on April 14th, all four major U.S. equity indices closed sharply higher. The NASDAQ 100 ETF, the QQQ, really led the charge with a pretty key technical breakout. And the main driver behind all this? It seems to be de-escalation signals coming from the Trump administration. They've announced some upcoming high-level talks with both Iran and Pakistan. We also saw a little bit of improvement in the Strait of Hormuz. 20 U.S.-approved vessels managed to pass the blockade line. Right now, it looks like the market is pricing in a compromise of about 10 years for Iran to suspend its nuclear program.
So let's get into the deep analysis on this. It says, the fading of the geopolitical risk premium was the trigger behind today's sharp index gap higher. Because both sides face substantial economic and strategic costs under a prolonged blockade, the market is inclined to adopt a price-in-first approach, discounting in advance the expectation that the geopolitical situation may shift from acute risk towards stabilization. This positive headline not only reduced the perceived probability of tail risk, but also resonated with underlying CTA inflows, pushing the market into a right-side trading zone.
All right, let's move on to our second section, which is all about inflation and volatility analysis.
Okay, so we actually got a pretty broad downside surprise in the March Producer Price Index, and that's providing a bit of a defensive cushion for the market. Let's break down the numbers. Headline PPI month over month came in at just 0.5%. That's well below the 1.1% consensus. Year over year, that figure was 4.0%. Then you have core PPI month over month. That was 0.1% versus a consensus of 0.6%, with the year over year number at 3.8%. And finally, Supercore PPI for the month was 0.2%, and the year-over-year figure there is 3.6%.
So what does this all mean for corporations? Well, the insight here is this. The below-consensus PPI print implies easing cost pressure at the corporate level, providing support for margin headroom into the upcoming earnings season. As long as macro data do not deliver an upside tail risk reversal relative to expectations, a benign inflation backdrop should allow capital to continue seeking alpha opportunities in technology and growth sectors. Now let's switch gears and look at the volatility market. The VIX is sitting at the 18 level, and total open interest is at a historically high 5.6 million contracts. And get this, of those call contracts, they account for a huge 3.8 million contracts. And the put contracts make up the other 1.8 million. So this kind of positioning creates a really interesting dynamic as we head into expiration.
And on that dynamic, the report notes something pretty important. The April 17 settlement is a key risk inflection point. Before then, short volatility positioning provides positive gamma protection and functions as a market stabilizer. After settlement, this volatility buffer will be removed, and the market may face the risk of a gamma flip. The quantitative conditions for the S&P 500 to maintain a modest melt-up are that the VIX stays below 15% and that the index's two-way intraday range remains within 1%. Once the index posts a single-day decline of more than 1%, the current stability structure will break down.
Okay, time for our third section. We're going to dive into the index and stock technicals now.
Looking at the NASDAQ 100, so the QQQ, it has confirmed a breakout above 628. That level is now acting as key support, and as long as it holds above 617, that uptrend is looking solid. Now, for the S&P 500, or SPY, it's, just a step away from all-time highs. The key resistance zone you really want to watch is right between 695.50 and 696.
And this really gets to why the S&P 500 is so crucial right now. The analysis highlights it perfectly. Although the Nasdaq has led the breakout, whether the S&P 500 can complete a V-shaped recovery and make new highs is the real core test of market breadth. A breakout in the S&P 500 would indicate that upside momentum has broadened from megacap technology into a wider set of industry groups, which would be an important signal that the rally is entering a more sustainable advance.
Now, if we look at the individual megacaps, things get interesting. There's some real dispersion here. NVIDIA, for instance, has gapped above 190, and it's looking at a medium-term target of 212. AMD, it's successfully reclaimed 241, with some near-term resistance between 266 and 267. Amazon broke above 236 with a target of 258. Google is holding above 325, and it's targeting that 340 to 349 range. Then you have Tesla, which is still kind of stuck, range-bound between 315 on the support side and 380 to 420 as resistance. And finally, Microsoft is just bogged down in a heavy supply zone, right between 397 and 430.
And speaking of Amazon's, there's a specific risk alert I need to share. It reads, the daily chart has already printed 3 consecutive gap-ups, creating a technical risk of an exhaustion gap. It is advisable to wait for pullback confirmation before positioning, rather than blindly chasing strength.
So, when it comes to allocation, where should you focus? Well, the guidance is pretty clear on this. Investors should prioritize allocation to names that have already completed right-side breakouts, such as NVDA and AMD. The probability of success in these assets has become meaningfully higher than in range-bound, base-building assets.
All right, let's bring this all home in our final section, flows, strategy, and conclusion. You know, a huge driver of this week's rally has been CTA funds. We're talking over $40 billion in buying. But the report offers a word of caution here. As more than $40 billion of buying is gradually absorbed, the incremental momentum from additional flows will weaken. Once CTA buying power is exhausted, the market will face a momentum vacuum caused by a natural pullback, and investors should remain alert to a potential shift in trading rhythm. So, how do you maintain portfolio resilience through all this? The report lays out 3 key pillars. First up is focusing on certainty in right-side trading. That means you position yourself when those high-probability trends are really clear. The second pillar is tolerance management. Basically, avoid going all in and make sure you keep some cash on the sidelines. And third, you need to have a rational view of mean reversion. Just understanding that pullbacks are a totally normal part of any long-term advance.
And that brings us to the final conclusion from the source material. Here it is. The market has entered a high-probability right-side trading zone. The near-term strategy is to primarily hold existing positions for further upside while closely monitoring changes in market volatility after VIX settlement and using the discipline of position management to handle potential momentum exhaustion risk.